Good morning, everyone. Welcome to the weekly Queenvest expert interview series, where we introduce you to preeminent professionals in the finance industry and bring you valuable perspective on succeeding as an entrepreneur, franchisee, or wealth holder. I am Ruzanna Queenan. I am a financial teacher, coach, and advisor, and I help entrepreneurs build generational wealth and ultimately change their family's future. And today, I'm excited to welcome Matthew Allen to our interview. Matthew is a consultant and Social Security advisor. It's a company that helps retirees navigate the complexities of the Social Security system and make right choices for their families. And today, we'll be chatting about Social Security in general, but particularly how entrepreneurs manage Social Security to maximize their benefits, both during their working years, but also in particular in retirement. Welcome, Matthew.
Thank you, Ruzanna. Thank you for having me, and I appreciate the opportunity.
Yes, same here. I know you guys have been helping retirees for many years. So what I'd like to do first is just learn a little bit about you and how you got started in the space and how you built your expertise over time.
Absolutely. I'd be happy to talk with you about that. My background actually is more as a general financial advisor historically. So I've been in financial services my entire career, but it was back in 2008 actually that my parents came to me and basically said, Matt, you're very good with numbers and figuring all these things out. And they were getting close to Social Security claiming age. I started to delve into it on a more in-depth basis, of course, because it was my parents, and just really realized how complex the Social Security system is. There's 2,728 rules. And so as I delved into what should be the proper plan for my parents, I recognized, because they're both quite bright people, that they were having problems making these decisions and were confused about it. A lot of other people probably would be too. So I teamed up with a co-founder of mine, and basically we built Social Security Advisors. That really involves three main things that we do for our clients. One is obviously all of that Social Security advice and planning, figuring out the when and how of claiming Social Security, to use those rules to your advantage. The second thing, that we do there is we actually do all the filings, or have the ability to do all the filings for actually getting the Social Security strategy implemented. So that's a big help for a lot of folks, that they often don't even have to deal with the Social Security Administration. And then number three, we do a lot of troubleshooting these days, because a lot of folks have problems with Social Security and they've tried to do something on their own, but they're getting stuck, or the Social Security Administration is telling them they can't do something when in fact they can. And so we navigate a lot of those things. So over time, we built up the company. We have quite a few Social Security advisors now in the firm. Most of those advisors used to work at the Social Security Administration before joining our team. I think the advisor with the least amount of experience was at Social Security for 18 years, for instance, before joining us. And the one with the most was at Social Security for 33 years. So it gives you a little bit of a sense of expertise and kind of the depth of our capabilities there.
Wow, that's incredible. And I would bet that it does take quite a bit of time to learn those rules and gain the experience, because Social Security is so complex. And similarly to you, when I became a financial advisor, one of my first clients who was approaching retirement had questions about Social Security. At the moment, I wasn't as well versed, but once I started to dig in a little bit, I understood a few things. One of them, it's a really complex system, so you got to know the rules and got to know how to help people. B, there is quite a bit of strategy that just starts way before you actually claim the Social Security. And then the third is that there are so many things that retirees can miss out on if you don't know where to look. Working with somebody like Social Security advisors, I think, can be a game changer, and probably either save you thousands of dollars or bring extra thousands of dollars in benefit. One of my first questions, since I work quite a bit with entrepreneurs, and I know that there is a difference between a Social Security for entrepreneurs and regular W-2 employees. Can you speak a little bit about what should entrepreneurs know about when they think about Social Security as they are working in their business, in their career, and how they should approach saving for Social Security, contributing to Social Security, and building up their own benefit base?
Yeah, no, I'd be happy to speak about that. Entrepreneurs have some really unique capabilities and rules that they can use, primarily because of the fact that anyone's Social Security benefits are based on their top 35 years of history. I'm just going to share my screen here for a moment, if you don't mind, and kind of show you some of the particulars. So this is right off of the Social Security Administration's website. And as you can see here, they say they use their highest 35 years of earnings. Why is that important for entrepreneurs? The reason is it really has to do with the way that this is ultimately calculated. Not to get too into the weeds on this for you, and we, of course, we make it really simple when we talk to folks, but this is what's called the primary insurance amount formula. So Social Security uses the top 35 years, and then they apply this formula to it, which has what are called bend points, three different bend points, A, B, and C. And for business owners that have the ability, at least in our experience when we deal with business owners, most of them have much more of an ability to control how they are paying themselves, as opposed to, let's say, somebody that is just working at Amazon or Microsoft or something and gets a regular W-2. So with business owners that have more of a capability of how to pay themselves, it can be really helpful, because once someone gets to the third bend point, level C of the formula, they basically only get about 15 cents of every additional dollar that they're putting into Social Security. So in other words, they're basically taking 85 cents, if you will, of each additional dollar and giving that into the general system and paying for other people's Social Security. Long story short, for business owners, there's great ways to optimize how you are paying yourself, so that you optimize basically what you get back from Social Security over time, how much of a monthly benefit you get, and you basically want to be optimized within this formula, and there are ways to calculate that and figure that out. But you want to be in a position where you're not paying too much in terms of payroll taxes, because, like I said, that's basically going into the general system once you get past this level C threshold. And so you can optimize your Social Security benefit with the proper planning, but you can also optimize how to be saving on payroll taxes, is my point.
Excellent. Yeah, that's a very good point, because I don't think Social Security is the first thing on your mind when you're starting a business and thinking about setting up your business structure and how much to pay yourself. I think many people want to minimize Social Security, payroll taxes, and the self-employed portion of it, maybe without realizing that it has a knock-on effect later in life. So what are a couple of pros and cons or considerations that entrepreneurs should think about when they're setting up their business or they're contributing to Social Security?
Sure. One big thing is the structure of their business, because the most popular ways that people own or run their own business would be just like a sole proprietorship, where they basically don't have any structure legally around it, and it just everything kind of flows through to their personal tax return. The other is an LLC. That's a very popular structure, and that still, though, flows through to the tax return. As much control of the ability to manage what I was mentioning with how you pay yourself with an LLC or a sole proprietorship. The pieces or the types that have the most and give you the most Social Security planning opportunities are S corporations and C corporations. The reason for that is when you have an S corporation, even if you're the only shareholder, you're the only person in the business, but if you have an S corporation and you are essentially then an employee of the business, so you are a W-2 employee, and that opens up the ability, let's say you have $100,000 of money coming into your business. And normally if you had an LLC, if that was all flowing through to your tax return as a profit, you would be paying 15.3% essentially for payroll taxes, because as essentially the business owner, you're paying 7.65% basically on the employee side, plus you're having to pay the self-employment side, so 15.3%. And so if you have $100,000 as an example there, and you're having to pay 15.3%, obviously it's 15,300 in the LLC structure, as an example. If you have the same $100,000, but it's in an S corporation, you have the ability to, as long as you stay within what's called reasonable compensation rules, and if you work with a CPA, they could guide you on what that is in your industry. The point is, as long as you stay within the reasonable compensation rules, let's say you pay yourself $30,000 as an example, and if you're still paying because you're the only business owner and have both sides of the obligation, the employee and the employer. So you're still paying the same percentage, but if you're paying the percentage on a much lower amount, that's $4,590 in that example, and you could pay the other $70,000 out of the 100 that we talked about as the starting point. You could pay the other $70,000 as a dividend or distribution, and this is the key point. Is that $70,000, there's no payroll taxes on the $70,000. So if you have your original, if you're comparing the structures, the original one was $15,300. The S Corp example, this also works with a C corporation, by the way, but you're saving right there $10,710 in payroll taxes. And if you structure it correctly based on this primary insurance amount formula, to figure out how much you actually should be paying yourself to hit the optimal point in the formula, it means you're going to ultimately maximize your Social Security benefit payment once you start collecting, as long as you do this consistently over time. But you're also going to save really a lot of money in payroll taxes along the way.
Wow, that's incredible. So many dollars of savings, which I'm sure every entrepreneur appreciates as they grow their businesses. But again, it speaks to the importance of overall planning when you're structuring your business and having the right team in place to help you with all these aspects of finances. So now I'd like to turn to pre-retirees, and it's time to start thinking about Social Security. And before we dive into the details, what I'd like to chat a little bit about, where is Social Security now? What do you see in terms of the current situation? I hear so much about cuts that the Social Security has had to its workforce, and they haven't been very fast before. So what are you seeing out there in terms of support that people have when they reach out to Social Security Administration?
Sure. Yeah, good question. I'll break that up into, I guess, a couple of pieces, if you don't mind. On the one side, I'll talk first about the, fiscal sustainability and a lot of things that you generally hear in the news, for instance. And then on the other side, I'll talk more about the functionality or lack thereof of Social Security and what's going on with all of that. In most recent news, just with what's going on with the administration efforts to proceed with a lot of the DOGE cuts and administrative cuts and things, there is quite a bit of concern within the Social Security Administration and with those looking from the outside in that some of those cuts have been very heavily in the IT sector. And so on a more immediate basis, I don't want to fully alarm anyone, but I think it is important to note that from the highest levels of the Social Security Administration, there have been concerns expressed that because of these types of cuts, basically what is going to occur is, or what could occur, I should say, is that it could actually basically break the payment system eventually, because their systems are based on some pretty old technology. And if they end up being in a position where they're not properly maintaining that and fixing that, it could lead to those kind of issues where perhaps there's even been talk about the first potential missed payment, for instance, in Social Security's entire history since 1935.
That's very concerning. Because for all of its maybe challenges and drawbacks, and I hear that Social Security has never missed a check payment. Is that right?
Yeah, no, they never have. And so that's the thing. That's on a more immediate basis. Longer term, I'm sure a lot of your listeners, or probably all of your listeners at one point or another, have heard that the Social Security Trust Fund is running out of money. And it is very true that there are significant structural issues over the long term. Basically, for a period of time when baby boomers were a lot younger, they were putting into there were a lot of people working, basically putting into Social Security, and that built up a surplus in the trust fund. The tide has reversed, and now there's more retirees, those same baby boomers, taking the Social Security benefits, and what's happening is there's not enough workers to basically keep up with that. So now it's running a deficit, and it's tapping into that previously existing surplus. They are projecting, depending on which actuaries you listen to, that generally between about 2031 and 2033 is that the trust fund would be essentially out of money. And if there was no action taken politically to fix it between now and then, that just to maintain a balance between the number of people working and the number of people retired, that Social Security would need to be cut by about 23% across the board. So people would still get 77 cents on the dollar. Now, obviously, that's not a very popular thing, especially for people that are already receiving Social Security. So there's been a lot of political talk and about ways to fix that and how to adjust the system. It's really important, I think, to mention at this point that this is not the first time around the merry-go-round with this. The system was basically in a very similar financial position back in the 1980s. And under the Greenspan Commission in 1983, basically what was done is that they changed a variety of things to improve the sustainability over time. So they raised the full retirement age. So like now anyone born after 1960, the full retirement age is 67 years old. There's been talk about doing that again and incrementally increasing that because people, of course, are generally living longer. Some of the other changes they made in the past is like raising the cap on how much of someone's salary or wages are subject to Social Security payroll tax. They changed the way that Social Security is taxed. They did a number of different things. And basically the goal in the 1980s was basically to position things for the next 50 years so that it was sustainable for the next 50 years. So that's why when this was done in 1983, we're now talking about roughly 2033, 50 years later. If history is any guide to this, I wouldn't expect any major action necessarily until we are pretty close to the deadline, because last time basically Congress waited until about 6 months before the trust fund was supposed to be exhausted and then finally made these fixes. I think it also is important to note, though, that there's been a lot of discussion among politicians and the proposals that have been put out there that there are some grandfathering provisions in some of those. Some of the proposals talk about being grandfathered in if you're over 55 years old, as an example, recognizing that, I think it's the politicians recognizing it's tougher to take money away from people that are already getting it as opposed to people who, are still in their careers and not really even thinking necessarily about Social Security.
Absolutely. So many people do depend on Social Security. It always amazes me how much security Social Security actually provides. So given all of this that's going on, is there anything that you advise differently to your clients today versus, say, 6 months ago?
Mm-hmm. Yeah, in terms of what's going on with the political environment and just the things that we just talked about, I would say it's more important than ever to work with a Social Security advisor to really just make sure that you're proceeding in the right way on when it comes to the execution in particular, the actual filings, because the Social Security Administration does make a lot of mistakes, and I don't see that getting any better. And with what we've seen with even in the last 6 months, I would say have seen an increase of more mistakes happening. I think as there's less employees and they are feeling more stressed and more overwhelmed, they're trying to move things through more quickly. And a tremendous amount is actually still done manually at the Social Security Administration, which is really problematic because now if you have more people rushing and just trying to get things off their desk, obviously that's going to increase the rate of mistakes. When we do filings professionally for clients, what we always do is we always cite the exact rules and regulations directly in the filing documents so that, number one, it helps the person on Social Security side figure out, for instance, what the strategy is. And then number two, it's really best to always have your filings in writing, in my opinion, so that if Social Security does make a mistake, that it can be appealed. We always use, I brought it up here on the screen, but we always use the rules and regulations right out of what is called POMS, or the Program Operations Manual System. This particular subchapter has to do with spousal benefits and how spousal benefits work. But POMS is basically like the internal Bible that Social Security has to go by. And so we always like to actually put the exact rules and regulations right in the filings too. So we're essentially using their own rules against them, and we don't give them any wiggle room on ultimately being able to try to deny something.
And that is, I think, the most valuable, one of the most valuable parts of your expertise. You know exactly where to look for the answers, and especially when it comes to things like spousal benefits, which I find that many couples aren't as focused on maximizing the spousal benefits and the survivor benefits as they should, perhaps because they don't know the what's available to them. But also there is a focus on perhaps breaking even or taking Social Security while it's there. So from your perspective, how should couples think about survivor benefits? What are some of the planning considerations that they should be aware of before they prioritize break-even rates and early benefits?
Yeah, no, good questions. The thing is, just on a high level view, what I always half jokingly, but it's really actually a serious issue, is that I always say most people spend more time planning a vacation than they do their Social Security. And that's a huge problem. Yeah, it's a huge problem still in our country, because I could put it a different way, that basically if you spend more time planning your Social Security, you can take more vacations. In any event, that's the biggest thing, because the whole Social Security system, you have to really keep in mind that the whole system is set up in a way that you, number one, have to know what you're eligible for. And keep in mind, there's 2,728 rules. So you have to know what you're eligible for, and then you have to proactively take steps to actually get that money, meaning doing the right filings and implementing that in the right way. The Social Security Administration is not going to come knocking your door down trying to put this money back into your account. A classic example of this is we sometimes run into folks that get confused with the minimum distribution rules that are around retirement accounts and the Social Security claiming age. Just keep in mind, Social Security stops growing at 70 years old. In the month that you turn 70, you're no longer, basically getting what are called delayed retirement credits, which are increases in your Social Security. They grow, generally your Social Security is growing at about 8% per year while you're waiting. But my point is that stops at 70, and sometimes people get confused about the minimum distribution rules, which are quite a bit after 70 now, and they're still working, so they're not really thinking about it. But then we sometimes get calls from folks saying, okay, I'd like your help in coming up with a Social Security strategy and doing my filing. And we say, what's your age? And they tell us 73. And we have to be in the really unfortunate position of saying to them, basically, that we can help them recover some money, because there's this rule right here, which deals with what's called retroactivity for Title II benefits. But a key point on this rule is that it is only for a total of 6 months. You can only go backwards for 6 months. And so in that case of that 73-year-old, we have to tell them, unfortunately, they have officially lost 2.5 years of benefits that they've left in the system. So again, just to summarize, you have to know what you're eligible for, and then you have to actually take action to get it.
Absolutely. And I can imagine that would be, I get the same questions quite a bit. There is a confusion between the retirement and Social Security, and what are some of the dates and what are some of the deadlines. So I feel like that having a team in place where you have your retirement plan and also somebody who can point you to Social Security advisors, for example, and say you should be speaking to them way before you're ready to claim Social Security is a great idea.
Yeah, absolutely. Generally, for time-wise, our sweet spot where we can have the most impact is generally between about 60 and 67 in terms of strategies. But we even encourage folks as early as 55 to start looking at developing their Social Security strategy and their plan. If they're a business owner, they should really be doing this as soon as they own the business because of what we talked about earlier in the conversation, that there's an opportunity to strategically set that up, and that'll pay huge dividends over the long term by doing that. To your point before about like break-even points and things like that, even I'll just show you a little bit. This is just one of the software programs that we use as Social Security advisors when we're helping our clients. But my point here is that a situation of break-even points and crunching the numbers, it depends on so many things because each person has a unique earnings history. So this is just a sample married couple, for instance. And obviously both the husband and wife are going to have unique earnings histories, but all the calculations are then also based on life expectancies, inflation rates, rate of return assumptions, things like that. What a lot of people do is instead of doing a proper plan is they hear something from a friend at a cocktail party and they decide to go that route because that's what their friend John decided to do, for instance. And it's really the worst thing you can do because John's scenario probably has nothing to do with your situation. So going through a proper analysis like this is really helpful because, like, as you'll see on the screen, in an example here where I've just put up some basic numbers of the waiting till 70 approach. But if you watch what happens here with the strategy, if we start to assume even a modest rate of return, let's say, for instance, you're in a position, it looks like I have to do it on a different client scenario here, but if you're in a position where you can either leave other money invested longer, or if you are in a position where if you were to take your Social Security earlier, I'm saying, or some clients will take their Social Security earlier and then they will maybe even directly invest that money. Or still a third way to look at it is claiming Social Security and then like paying down a debt as an example. So my point is once you factor in a time value of money into that, meaning like there's an opportunity cost to the money, it generally changes the strategy quite significantly. Instead of being those 70 ages, it can really bring it down to something a lot earlier of a claiming strategy. And then keep in mind also there are the spousal benefit considerations and the survivor benefit considerations. And just a quick point on that with survivor benefits, the general rule of thumb there for those that are married or that are divorced, but divorced after having been married for at least 10 years, is that the survivor can get the higher of the two benefits. So in a scenario where you have a married couple, where there's been a pretty big difference in the earnings history, it's always going to be really important, or I should say extra important, for the higher earner in particular to decide optimally when to claim, because the higher earner has to keep in mind, effectively, they're making a decision not only for their own benefit, but they're making a decision on what their lower earner survivor could potentially receive as well. So that's kind of the more sensitive piece of that kind of client scenario.
Oh, absolutely. It's a great information. And I'm excited to be also working with you guys going in the futures to bring this important service to my clients as well, because I do the idea of comprehensive planning. And that's what I do for my clients. It's not usually in finances, and especially again, when you're an entrepreneur, everything in your financial life is related. And the more you do a complete plan versus a piecemeal, the more benefits you will gain from your savings and your life's work, but also Social Security as well. So Matthew, if our listeners would like to get in touch with you, learn more about your services and how you can help, what is the best way to do that?
Yeah, generally visiting our website at socialsecurityadvisors.com. And then a really great way to start is if you have some questions, there's an online chat here. You can just put those questions directly in there, or you can set up a free initial consultation. There's free initial consultation buttons all over the website, and you can basically just jump on here and go ahead and book a time that works for you. And we talk with you more custom, obviously. It's custom to your questions and your scenario, but it's free to do that. And we can give you a better sense of important considerations in your case, things you should be thinking about, opportunities that are potentially there for you, and then obviously also how we can help you realize those opportunities.
Excellent. Thank you for sharing that. And we will put in the description in the show notes the links and contact information for Social Security advisors. Matthew, thank you so much for this conversation. I think that my listeners will have had a great insight into how they should start to plan. And in one of what we didn't touch upon today, and we should absolutely do that in one of our next conversations, is Medicare. And what are the Medicare considerations that retirees need to be thinking about, and how to coordinate those benefits so that they are taking optimal distributions from their retirement plan and managing the income and also their retirement and government benefits in the best way possible. So thank you so much.
Thank you again, Ruzanna. I appreciate the opportunity to be with you. Thanks again.